Welcome to Talk Tickers, the place where we cut through all the earnings call noise and really distill actionable insights straight from the source. Today, we are undertaking a pretty crucial deep dive into the Q3 fiscal year 2026 results for the financial software company nCino, that's ticker nCino.
And this call, which, hit the wires after hours on December 3rd, was arguably the most critical for the company this year.
Oh, for sure.
You really have to remember the context here. It's a key to understanding the sheer weight of these results. I mean, nCino has been in the investment penalty box ever since that dramatic stock drop back in April 2025.
Right.
That event, it fundamentally changed the mandate for management. They weren't just reporting quarterly numbers, they were reporting on a turnaround. They had to prove that the internal restructuring, the cost discipline, and their big push into AI were translating into real, immediate financial performance.
And based on the market reaction, they didn't just meet that mandate, they absolutely obliterated it. So let's look at the headline financials right away, because they really paint a picture of kind of operational redemption.
Yeah, let's do it.
On the profitability front, the non-GAAP EPS came in at a remarkable 31 cents.
31 cents.
Yeah.
And to put that in perspective, the consensus was sitting somewhere around, 20, maybe 21 cents?
Exactly. That's a staggering 50 to 55% surprise beat. And that translates to a 51% increase year over year.
And what really stands out to me, and this is so important for a software company that has traditionally been growth-focused, is the monumental shift on the GAAP line.
Oh.
They reported a positive GAAP EPS of 6 cents per diluted share. That is a major strategic pivot from the 5-cent loss they posted just a year ago. It confirms the company has now, successfully moved past that growth at all costs phase.
Right. They're showing they can manage profitability alongside the expansion.
Yes. And that change in narrative for valuation purposes is just huge.
And that new discipline, it's clearly reflected on the top line too. Total revenue reached $152.2 million.
Which surpassed the street consensus by a solid 3%.
A solid 3%. And it's still growing 10% year over year. And maybe most importantly for the long term, their subscription revenue, the sticky recurring lifeline of a software company.
The good stuff.
It hit $133.4 million. That represents 88% of total revenue and shows really healthy 11% year over year growth.
But if you look behind those numbers, the true engine of this quarter's success wasn't just higher than expected revenue. It was really all about margin expansion.
Ah, yes.
Management successfully executed what we call a beat and raise, and it was all built on operational efficiency.
Okay, let's unpack that margin story, because this is where the numbers get, pretty intense. The non-GAAP operating margin hit 26%.
26. I mean, we were talking about a 600 basis point expansion year over year.
Which is huge. For anyone unfamiliar, when a massive operation expands its margin by 600 basis points, that's 6 percentage points. It means for every dollar they bring in, they're retaining 6 cents more in profit than they were last year.
Yeah. And that non-GAAP operating income was $39.9 million, a 42% spike year over year.
So what was the secret sauce? What did they say on the call?
The CFO was very clear on this. It boiled down to basically 3 key things. First, just successful execution of their plan and their sales motions.
Okay, standard stuff.
Right. Second, and this was probably the biggest driver, was the concrete realization of net savings that came directly from that May restructuring. Those planned cuts are now translating into leveraged dollars.
Got it. And the third?
Ongoing stringent cost discipline. They specifically mentioned that they are leveraging their own internal AI tools to streamline their operations, so applying their core product principles to themselves.
Okay, so here's where the critical questions start to emerge for me. When you look at the incremental non-GAAP operating income margins, Q3 hit nearly 90%.
90%, meaning 90 cents of every new dollar of revenue went straight to operating income.
That is just incredible leverage. But then management signaled that Q4 could potentially hit 130% at the high end of their guidance range. How is 130% physically possible? Is that sustainable, or is that just some accounting magic from the restructuring?
That's the exact question you should be asking, and it really speaks to the profound shift they've engineered. The 130% figure, it isn't an ongoing run rate, no.
Okay.
But it is a function of capturing the tail end of that restructuring synergy, combined with seasonal factors and the platform's natural scalability. It confirms they have built a much leaner, more efficient machine post-restructuring.
So the real story is that even if that number drops back to a still very healthy, say 40 to 50% leverage next year, they've fundamentally changed their cost structure.
Exactly. They are demonstrating that the platform is ready to scale without these, commensurate increases in operating expenses.
That's a powerful validation of the whole strategy. And while focusing on that operational efficiency, they didn't neglect shareholder returns. They confirmed the completion of their previously authorized $100 million share buyback.
Repurchasing about 4 million shares at an average price of $25.52.
And a quick word on the balance sheet.
Yeah, brief word on that. They ended the quarter with $87.9 million in cash. We should, acknowledge the $203.5 million drawn on the revolver.
Right.
However, given the overwhelming positive narrative here, the market is clearly prioritizing that operational turnaround over the near-term leverage profile. The focus is squarely on growth and margin.
Which brings us to the qualitative narrative, the platform, the AI, and the proof points that the CEO, Sean Desmond, spent a lot of time emphasizing. The story has really shifted from just cost cuts to AI-driven value.
Absolutely. The AI adoption metrics aren't just, high-level strategic talking points anymore. They are concrete, monetized facts. They reported that over 110 financial institutions have already purchased banking advisor intelligence units.
So this is a direct measure of customers actually paying for specific AI capabilities right now.
Right now, it confirms monetization is happening, and it's happening early.
And the customer outcomes they cited on the call they're genuinely shocking in terms of efficiency gains. Let's just pause on these examples for a second.
Please.
They cited a $5 billion U.S. bank that eliminated 86% of duplicate data entry using nCino's platform. Just think about that. That is a massive reduction in human error and compliance risk.
But here's the one that should make every competitor nervous. Another $5.2 billion institution reduced its entire underwriting time for specific commercial tasks from 23 days down to just 2 days.
23 days to 2 days.
Think about the competitive advantage that gives a bank. They can approve loans faster, serve customers better, and drastically reduce their capital costs. I mean, that is the true measurable value proposition of the nCino platform right now.
And to maintain that edge, they're expanding their AI offerings pretty aggressively. They launched role-based digital partners. These AI agents trained on 13 years of banking data.
So they're specialized tools for like an analyst or a relationship manager.
Exactly. And management expects to have about 100 banking advisor capabilities available by the end of the fiscal year. That's a huge acceleration from the 18 they had just 7 months ago.
And this innovation pipeline, it directly supports their most crucial strategic lever, the transition to platform pricing.
Ah, yes.
Management is actively migrating customers from these older, often bespoke licensing models to a standardized platform or asset-based pricing model. This is where they ensure they are capturing the value they deliver.
Can you explain why this asset-based pricing model is such a big deal for investors? Because it kind of sounds like an internal technical change.
Oh, it's absolutely critical for the valuation story. Think of the old model as sort of consumption-based, where a customer might pay based on how many users they have.
Okay.
The new asset-based model means they're paying for the total value of the platform's capabilities across the whole organization, especially access to those new AI tools. By converting customers, they basically guarantee an economic uplift.
And they gave us some numbers on that.
They did. They noted that 27% of their total annual contract value, or ACV, is now converted to this model. That's up from 21% just last quarter. And the targeted average uplift on renewals under this new structure is about 10%.
So every time a customer renews and converts, the guaranteed revenue from that customer just immediately increases.
It's an automatic 10% raise, basically.
And what's interesting is what's driving that conversion. Management said it's not forced. Early renewals are being specifically driven by customers who want immediate access to those new AI capabilities.
Which underscores the platform's value. Customers are willing to pay more and pay sooner just to get their hands on these efficiency tools.
And we're also seeing great traction across other business lines and geographies. International execution remains really strong.
Yeah, they secured a major win with a regional bank in Japan, over $80 billion in assets, adopting nCino Mortgage. This proves the product is translatable outside of core Western markets.
Right. And domestically, they had expansion deals with 2 separate top 50 U.S. banks. They increased their commercial commitments by over 30% and over 60%. These aren't new logos. These are existing clients deepening their commitment.
Which is the best form of validation, right?
It really is. Even their acquired assets are paying off. The DocFox acquisition is fully integrated, and its pipeline growth is outpacing the company average.
And don't forget the integration gateway solution. That secured an ACV uplift on a renewal with a $90 billion check bank. So global expansion, cross-selling, it's all clearly working.
So we have strong execution, margin expansion, AI monetization, and a successful pricing transition. What does this all translate to in the guidance for investors?
They confirmed a significant raise, both for full-year revenue and non-GAAP EPS. The new non-GAAP EPS guidance is 90 to 91 cents.
Which is dramatically ahead of the prior consensus of what, 79 cents?
A huge jump.
This brings us to the ultimate strategic target they reiterated on the call, the Rule of 40. Management stated its commitment to approaching the Rule of 40 metric by the end of fiscal year 2027. That's calendar 2026. For our listener, can you briefly explain why the Rule of 40 is sort of the holy grail for software companies?
Absolutely. The Rule of 40 is the benchmark of operational health and value in the software industry. Simply put, it states that a company's revenue growth rate percentage plus its profit margin percentage should equal or exceed 40.
So, for example, if you grow at 20% and have a 20% margin, you hit 40.
Exactly. Or if you grow at 30% and have a 10% margin, you still hit 40. Hitting that metric is critical because it signals a balance between growth and profitability. And companies that consistently achieve it typically command premium valuation multiples in the market.
And given nCino's current position, 10% revenue growth and 26% margin, they are currently at 36. So they are close. Yeah. And that commitment to approaching 40 by FY 2027 is a clear signal to the market.
It's a very clear signal that management is focused on achieving that premium valuation status. They are betting on re-accelerating bookings driven by AI and those pricing uplifts, combined with the newfound leaner cost structure that is already delivering those 26% margins.
The timing feels right. Banks aren't debating AI anymore. They're demanding quick deployment.
And nCino is perfectly positioned as that trusted, domain-specific AI layer sitting on a single platform commercial consumer mortgage leveraging its 13 years of banking data.
Now, we need to talk about the disconnect. Because even with this stellar execution, the stock price remains depressed. The stock is still down about 40% over the last year.
Which is incredible when you compare that to the broader software peer group ETF, which is up close to 29% in the same period.
It's a huge gap.
And that is the crux of the investment opportunity. The market is still treating nCino like the underperforming company it was back in April, not the company that is now delivering 10% growth and 26% non-GAAP margins.
The material lag between the fundamental momentum and the trailing share performance suggests massive potential for a re-rating.
Massive potential for multiple expansion if this execution holds. The market needs to re-rate this stock.
And this brings us to our This Is Not Financial Advice segment, where we transition to a wild yet plausible trade idea based purely on the narrative we just synthesized.
Okay, so the thesis is rooted entirely in that Rule of 40 turnaround story. The strong after-hours reaction, that 6.1% pop, it confirmed the turnaround narrative is being digested by the market.
But not fully.
Not nearly fully. The stock is still significantly discounted compared to software peers that are showing similar AI-led growth catalysts. The current fundamentals, the raised guide, the 110-plus customer AI adoptions, the proven margin expansion, it all contrasts so sharply with that depressed one-year share performance.
So the bet is on the market eventually waking up and recognizing the inherent leverage in the model. What's the specific trade structure you're thinking of?
The trade is long-dated call options. I'd recommend looking, 18 months out for duration. This targets a price level consistent with peers that successfully trade at or near that Rule of 40.
So this is explicitly a bet on the multi-year re-rating, the multiple expansion, not just incremental quarter-over-quarter revenue growth.
Exactly. It is predicated on management hitting that Rule of 40 target by the end of FY 2027. We already saw pre-earnings bullish sentiment reflected in the put-call ratio of 0.15, which means options traders were expecting positive news. This trade just leverages that underlying belief in redemption.
Okay, so what are the main risks or hedges that an investor needs to be watching out for if they take this kind of multi-year view?
The lingering concerns really revolve around the capital structure. First, the balance sheet leverage, specifically that $203.5 million drawn on the revolver.
Right, that's not insignificant.
And second, the anticipated free cash flow seasonality, which is historically lower in the second half of the year. So investors must monitor management's ability to maintain strong cash generation alongside this aggressive efficiency push.
That's a really deep analysis. To quickly recap, nCino delivered a huge beat and raise quarter. They demonstrated immediate monetization potential with over 110 customers adopting their AI intelligence units. And most importantly, they reaffirmed management's conviction in approaching that Rule of 40 path.
And the final provocative thought for you to explore is this. Extensive research has shown that nCino customers demonstrate, on average, a 64% better return on average assets than their non-nCino peers. So given that demonstrable competitive differentiator and the associated AI halo effect, turning 23 days of work into 2 days, the question for investors is simple. When will the market finally price in the value of that proven operational outperformance?
That's the rule of thumb to hold on to. Thank you for joining us for this deep dive into nCino's Q3 results. We look forward to connecting with you next time to analyze another crucial earnings call. And remember, everything discussed here is for informational purposes only. Do your own research and happy investing.